Have you ever wondered how a tiny startup idea balloons into a massive corporation? Well, today, we're pulling back the curtain on the official rulebook that makes it all possible, the Companies Act. We're going to follow the entire journey of a company, from start to finish, to see how these rules shape its life. So what is it? What's the real difference between your local neighborhood shop and a giant company that's listed on the stock exchange? Is it just about the money, or is there something, more fundamental going on? Well, the answer really boils down to this powerful set of rules. You can think of the Companies Act as the operating system for every corporation out there. So come on, let's follow the story of a company right from its birth through its growing pains and all the way to how it navigates the big wide world. Okay, let's get into it. Every great company starts with an idea, right? But ideas need fuel, and that fuel is capital. So how does a company go out and legally ask the public, hey, want to invest in us? It all starts with this thing, a prospectus. This is basically the company's detailed dating profile. It's an invitation to offer that puts all the cards on the table, the financials, the risks, the game plan. The whole point, and this is crucial, is to protect investors through full disclosure. No secrets, no hidden surprises. Now, when it comes to raising money, a company has two main routes. They can make a public offer, which is like throwing a giant concert for absolutely everyone. Or they can do a private placement, which is more like an exclusive invitation-only event for a small group, no more than 200 people. Let's make this real. Imagine a company, we'll call it Tech Growth, wants to go public. First, they released what's called a red herring prospectus. It's like a draft with a price range instead of a final price. Then investors like you and me start bidding, and the market itself discovers what the final price should be. Only then do they file the final prospectus and hand out the shares. It's a very, very structured dance. And this is where it gets really interesting. There's a rule called minimum subscription. If a company doesn't manage to raise at least 90% of the money it's asking for, the entire offer is canceled. Poof. Every single rupee goes back to the investors. This rule is there to stop a company from starting out severely underfunded and failing right away. It's truly an all-or-nothing game. So, success. The company raised the money. Fantastic. But that capital can't just sit in a big, messy pile. It needs to be organized, it needs structure. Let's take a look at how that actually works. You've got two basic flavors here. On one side, you have share capital, or equity. This means you own a tiny piece of the company, you get a slice of the pie, and a vote on how things are run. On the other side, you have debentures, which is basically debt. You've just loaned the company money. You're the bank, not an owner, so you get interest payments back, but you get zero say in the big decisions. Now, here's a pretty cool rule that keeps companies financially healthy. A company is allowed to buy back its own shares, but there's a catch. It can't use more than 25% of its core capital and reserves to do it. This is super important because it prevents a company from essentially gutting itself financially, which protects everyone who has loaned it money. Okay, so we've got the money and we've got the structure. But who's actually steering the ship here? Who's making all the critical decisions? Well, that brings us to the brain of the company, the board of directors. And the law is really clear about this. A public company needs at least 3 directors. A private one needs 2. And a one-person company, well, you guessed it, just 1. This is a fundamental concept in business, separating the people who own the company from the professionals who manage it. And it's not just about hitting a number. It's about having the right mix of people. The rules say you need at least 1 director who actually lives in India for local accountability. Larger companies need to have a woman director to bring diverse perspectives to the table. And for listed companies, this one's huge. At least a third of the directors must be independent to protect the smaller shareholders. So, we have a board running the show, but who keeps them honest? Who makes sure the numbers they're showing everyone are actually real? Enter the auditor. An auditor's job is to be the completely independent watchdog for all the shareholders. They go through the company's books with a fine-tooth comb to certify that the financial statements give a true and fair view of what's going on. Their independence is absolutely everything. And to make sure that independence is protected, the law forces something called rotational audits. An audit firm can't just stay with a company forever. After 2 5-year terms, so 10 years max, they are out. They have to take a mandatory 5-year cooling off period. This makes sure a fresh, unbiased pair of eyes is always checking the books. All right, the company has its money, it has its structure, and it has its management. The stage is set, now it's showtime. And that usually means 2 things. The good stuff, like payoffs, and the not-so-good stuff, like problems. When the company's doing well, shareholders want their cut, right? A dividend. And the rules on this are incredibly strict. A company has exactly 30 days to pay it out. If some of that money isn't claimed, it gets moved to a special bank account. And if it's still sitting there after 7 years, it goes to a government fund that's used for investor education. But what happens when things go wrong? Disputes between shareholders or accusations of mismanagement. That's where the NCLT comes in. Think of it as a special court just for corporate drama. It's staffed with experts who get this stuff, so cases get resolved much faster and more knowledgeably. And there's a really clear, logical path if you don't like a decision. You start at the NCLT, you can appeal that to the next level up, the NCLAT, and after that, the final stop, the last word, is the Supreme Court. But, and this is a big but, they'll only hear your case if it involves a major unresolved question of law.
So, if you step back and look at this whole journey, from the first fundraising document to the final court of appeal, there's one single idea that ties it all together. The entire system is built on one simple, powerful mission: protect investors. And the way you do that is through disclosure, by making sure everything is out in the open.
The Companies Act has built the entire framework for the corporate world we live in today. But business, technology, and finance are evolving at lightning speed. It really makes you wonder, what is the next chapter for this essential rulebook going to look like?